Can you deduct the interest you pay on life insurance policy loans while practicing infinite banking? In this episode, I'll discuss the scenarios that policy loan interest is deductible and the easiest way to account for the deductible interest. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. Let me start the episode out today by saying I'm not a tax advisor. Do not take this as full-fledged tax advice by any stretch. And this is going to be more of a general episode to some degree, as far as I can't get into the weeds of the tax code, nor would I be the right guy to do that. But I will. I wanted to share today what we've learned from working with different tax accountants, tax professionals, and just kind of relate it to you, especially in regards to deducting policy loan interest while practicing infinite banking. If you've ever tried to do this, by the way, so if you're an infinite banking practitioner and you've talked to your tax accountant and you just say, hey, I've got this life insurance policy loan, and here's the interest I paid to it, can we write this off? I think the first thing they'll be like, what the heck are you talking about? And no, you can't write off interest. And so really, and I don't blame them for saying that, and we're going to dive into why they say it that way, but really I wanted to discuss the parameters for deducting interest today. Not a tax advisor, though. Do not take this as truth by itself. Go speak to all the people you need to speak to actually get this done. Tax professionals in your life will know way more than I do on this front. But what I wanted to do, let's go ahead and just dive into it. Life insurance policy loan interest. So for those of you who are practicing infinite banking, you're taking policy loans, life insurance policy loan interest is not tax deductible by itself in a vacuum. Just by itself, it's not tax deductible. Which is why most accountants will say, hey, you don't get to deduct policy loan interest. And they're right in a vacuum. And that way it's not like mortgage interest. Like mortgage interest, there's a piece of the tax code that says, hey, if you go buy a home, the interest you pay on the mortgage is tax deductible. It's always tax deductible. Policy loan interest doesn't work that way. It will fall under the general provisions for the most part. There are exceptions, like there are times when they fully say it's not deductible under these scenarios. How you fund the policy can impact whether it's deductible. And the other things can impact the deductibility of policy loan interest. There's exceptions that I'm not going to be able to go into today because I don't even understand them fully either. As a general rule, low policy loan interest is not tax deductible by itself like a mortgage interest would be. But it falls under the general rules for deducting interest that we all have to follow for everything else. So the rule of thumb for deducting policy loan interest is that policy loan interest is deductible to you if, under the circumstances, it would have been deductible using somebody else's money. So let's paint the picture of this. If I was to go out and purchase a car and borrow money from a bank, and it's going to be my personal car, the interest I pay on that car loan is not a tax deduction to me. I don't get to deduct the interest I pay on a car loan. So in that sense, car loans are not tax deductible. The same thing goes if I have a credit card and I've run up a balance on the credit card and I'm paying interest on the credit card. It would be nice, but we don't get to deduct policy loan interest on credit card loans either. However, the general idea of deductibility of interest comes into play under all of these circumstances. So let's say instead of me buying a personal car, I went out and I bought a car. I'm a plumber, let's say, which I would be the world's worst plumber. But let's say I was a plumber and I would need to buy a van for the business. Suddenly, I could go out and get a loan to purchase this van, but since the vehicle itself is going to be used for business purpose, now what used to not be deductible is now deductible. Now the interest I pay on that loan for the van is a deduction. It's a regular business idea to borrow money to buy a van if you're a plumber and so forth. The same thing would be the case for credit card interest. Businesses have credit cards. If you were to, swipe a credit card and run a balance and pay interest to a credit card company in your business, then suddenly that interest you pay on the credit card, it actually is deductible. It's an expense to the business. And the same thing goes if you were to make an investment. If I was to borrow money from my buddy, the interest you pay back to the friend is not a tax deduction by itself in a vacuum. It can turn into a tax deduction based on what you use the money to do, which is the case for all of this concept. So if I was to go borrow money from a friend, $100,000, pay him 10%, not a deduction. If I was to then go take the $100,000 and buy some sort of investment, some sort of asset, maybe real estate property or something, then suddenly the interest I paid to my buddy is a tax deduction to me. Same thing goes if you were borrowing hard money to do a deal. The interest you pay to the hard money lender is tax deductible. Is hard money in loan interest on hard money lending, is that a tax deduction in the tax code? No, it just falls under the general principles for tax deductibility, just like everything else. And so this brings us back to life insurance policies. Borrowing money from your life insurance policy is not a tax deduction by itself, but what you do with it will determine whether the interest you end up paying on the policy loan is tax deductible. So if I was to borrow money and I was to use it in my business, and I take a policy loan for $100,000 and I go buy a new van, a new plumbing vehicle for my plumbing business that's imaginary. Thank the Lord it is imaginary. And I was to borrow $100,000 from my policy to go purchase that. Suddenly, I can deduct the interest I pay back on the policy. A typical car loan for me personally would not be, but if I was to use it in my business, suddenly it's a business purchase, and the business can write off the interest paid back to the life insurance company on a policy loan. You can borrow money against all sorts of different things in life, and just the interest is not tax deductible by itself. It can become tax deductible based on what you use it to do, and the same thing applies for life insurance policies. And so if I was to borrow money to go buy the van, my business can expensive. If I was to go borrow money from my policy to invest in an investment of whatever it is I want to invest in, suddenly the interest I pay on that policy loan becomes tax deductible to me, just like it would be if I had borrowed it from anywhere. That's the idea. The rule of thumb is that policy loan interest is tax deductible if you could have borrowed it from anywhere and paid interest back to whoever you borrowed from. If that interest would be deductible to anywhere else, it's deductible to us for the most part, under most circumstances, when using your policy. There is something unique about this, though. And so what I want to do now is I want to talk about kind of what makes policy loans unique, and then I'm going to dive into some practical steps. Like here's, just practical suggestions for accounting for the deductibility of policy loan interest. But what makes policy loans unique is the fact that I can borrow money against my cash value. And remember, I'm posting my cash value as collateral. I can take a loan out against it to go do something in the world of a business or investment purpose. That's the way most interest works in general, by the way. But what makes this unique is that the cash value in the policy is going to continue to earn its guaranteed cash value growth increases alongside its annual dividend. It's going to earn interest and dividends on the full balance even while there's a loan outstanding. And what makes this unique, though, is that the loan can be tax deductible. The interest you pay on the loan can be tax deductible. But the policy is going to grow, essentially, in a tax-free environment. It's not fully tax-free. It's technically tax-deferred, because if you were ever to close the policy down, it kind of counts like a sale of an asset, in which case you'd have to pay taxes on any gains you made if you were to do that. Hint, hint, the way around that is just to never plan on closing the policy down or withdrawing more than your basis in the policy. The goal would be just take policy loans out as needed, which a loan is not a taxable event. So a policy loan is never a taxable event as long as your policy is not a modified endowment contract, a MEC. A policy loan is never a taxable event. But that, once again, that just falls from the general rules of loans for the most part. A loan is not a taxable event in the great wide world of finance. You don't have to pay taxes whenever you borrow money to buy a car. That's not revenue to you. It's a loan. Same thing goes in policies. So what I'm trying to bring up is policies are going to be growing essentially what it feels like to us is in a tax-free environment. Let me compare this to another thing, just kind of help this hit home a little bit. If I was to go put money into a CD at a bank, a certificate of deposit, and let's say I was in a CD that's paying me 5%. Most banks would love if you were to go bring your CD back to the bank, your CD account, and say, hey, I've got $100,000 in this CD. Can I borrow $50,000 against this CD because I need to go, let's say, invest money in a real estate project or something like that. So I've got a 5% CD, and I'm going to borrow against the CD to go make the investment. Let's say the loan rate is 6%. If I was to go use that for business or investment purpose, the 6% loan I just took from the bank would be tax deductible to me. It's a loan from the bank at 6%, and I went out and I used it to make an investment or in my business or something like that. And so I now get to deduct 6%. But what makes it a little bit different than the policy side of things is that there's no tax favorability for the 5% interest that's earned inside the CD. You're just going to pay full income tax on that 5% gain. So you might net something like 3% or 3.5% after it's all said and done. But that's why policies are so unique. If I was to use that policy loan to go make the investment, I would still get to deduct the 6% interest I'm paying. But on the back end, I don't have to claim the growth of the policy and the dividends of the policy earned as income to me. This is a huge deal. This is why it's so unique. Because now, let's say I'm in the 40% tax bracket between my state taxes and my federal taxes kind of all added together. I'm in the 40%, let's just say. 40% of 6, I think, it's going to be 3,200 or 3,600, excuse me. So essentially what it is I ended up turning my 6% interest. If I'm in a 40% tax bracket, the net effect to me is that it feels like I'm only paying 3.6% interest because I'm getting a tax deduction on the 6%. So I'm actually only paying a net of 3.6 after tax. But yet my policy was continuing to grow at 5 and I don't have to claim that, which makes this extremely unique. That's why we love doing it. That's why we think it's the greatest place. I mean, for a whole bunch of reasons. Remember, as I've said before many times in the show, there's not just one reason that IBC works well. There's not just one characteristic. There's a whole bunch of characteristics about these policies that when you bake them into a cake all together, you put all the ingredients together, you're like, this is an amazing place to build capital, to help expand my business, to help make investments, just to live life. It's an amazing place.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escape-the-bank. You'll receive instant access to what we call the Beginner's Course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escape-the-bank to gain access to the free course today. Now back to Nate and Holly.
Now I'm going to dive into a few practical suggestions for deducting policy loan interest. These are just suggestions of mine. My first suggestion is to try not to mingle personal use and business or investment use in the same policy. Sometimes this cannot be avoided. Sometimes you may only have one policy and you have to use it sometimes for personal use and sometimes for business or investment purpose. But this is certainly helpful for those of us like myself who have multiple policies over time. It is so much easier to keep account for how much interest is deductible if you don't mingle the policy use. And the reason for this is kind of obvious. Like, let's say I've got one policy and I've taken out a whole bunch of money for personal and a whole bunch of money for business. I'm actually only able to deduct the interest I'm paying on the business side of things, but the insurance company just sends me one interest bill every year. The responsibility is on me now to figure out how much of that interest was tied to my business and investment use purposes and how much of that interest was tied to personal, and it just becomes kind of an accounting headache. All that to say, my first suggestion is that if you have the ability, try to keep some policies for personal use and some policies for business or investment use if you can, because then it makes accounting super simple. The second thing to note is that you really should have a separate account. We call it the segregated account or the transfer account, that the only money that ends up hitting that account is policy loans that you're going to go put to work somewhere else. This can be very helpful. And so the reason why this is very nice is because it creates a very clean paper trail. If you were ever to get audited for any reason about the interest deductions that you're claiming while practicing infinite banking and writing interest back to policy loans, it would be really nice if you could just say, hey, this was the bank account that I borrowed money from my policy. It hit this separate account, and then from there I made the investment. So I borrowed $100,000 from my policy. It hit this separate account, and from that account I wrote a $100,000 check to make an investment. And then every year when the interest bill comes due, the interest or the investment income will come into the transfer segregated account, and we'll pay the interest from that account as well. And it just say, hey, all tied up in this one little account is all the transactions I did, and you can easily see the purpose for it. You didn't mingle any of the money. And you're like just personal everyday checking accounts or things like that. So it's very simple. Just an easy suggestion for you and your account that makes life easier. The next thing to note is that, as I mentioned just briefly, the insurance company is going to send you an interest bill just once a year, by the way, on your policy anniversary date, whenever that is, for the total amount of interest that has accrued on any of your policy loans over the course of that policy year. And so when the insurance company sends you the interest due, I would recommend paying that interest when it's due, is my recommendation, and to have a nice clean paper trail where you actually write a separate check or have a separate transaction, or at least be able to easily read it, that you paid interest for X amount of money. And that is the paperwork technically that you're going to give to your accountant to write off the interest. Let's say you borrowed $100,000 at 5%, and you get a bill for $5,000 for the year of interest. You write a check for the $5,000 at that time, and you hand that bill to your accountant saying, hey, this was my business or investment use policy that had $5,000 of interest expense. I paid the interest expense, and here's the documentation for it. So they're not going to send you like a 1098 interest form, like a mortgage interest form. They're not going to send you those types of things. They're just going to send you the interest. They don't know what you use the money to do. The insurance company, of course, they're not sending out 1098 forms for the interest you pay them to deduct on your taxes. You have to manually do that in a similar way that if you borrow money from a buddy or a hard money lender or something like that, they're not going to send you a 1098 tax form per se. The last thing is that if you have to commingle your policy for business purpose and personal use, and there's no way around it, which is quite common, you just don't have enough money to be able to kind of set aside one policy for one use and one for the other. You got to just mingle them at the same time. That's perfectly fine. My suggestion, if you had to mingle you have one policy and you use it some for personal, some for business, my typical suggestion is to treat all of your business or investment policy loans you've taken as interest-only loans for the most part. So if we can treat them as interest-only loans, we're not going to be paying random amounts down to the policy loans used for business or investment. That can kind of keep things easy. So if I borrowed $50,000 4 times, and so I've got $200,000 borrowed out for business and investment purpose, if I just keep paying that interest only, then really I have the same amount of interest due each year, and I can really dumb down my accounting. And so maybe the interest will fluctuate based on how much personal use I've been using from the policies. So I may have some personal use loans, of course, that their balances may rise and fall. But my business use, I'm not making random principal payments per se. That's just a helpful suggestion if you really don't want to be, keeping track of every dollar and every cent and trying to get into an accounting nightmare for how much interest is going to be deductible. You just kind of have set a number that's going to be, and you can pay down big chunks once a year. Maybe at the anniversary date, you pay down like $100,000 for the business use of a property sold or something, and you were to write a check back. That can keep it easy. So if you have to commingle the use, it is nice to not amortize the loans you've made for investment purpose and business purpose, and try to account for that amortized amount of interest. Just treat them as interest only and make lump sum payments on the anniversary dates. That can be very helpful. Once again, all of those were suggestions. None of them are required. All of them are suggestions. The deductibility of the interest a little bit easier for you. So to wrap up, Nate is not a tax advisor by any stretch. Go talk to your tax advisor to get real tax advice. But from what we've learned over the years, it seems likely that life insurance policy loan interest falls under the general rules of interest deductibility that is available in the wide world of finance under the vast majority of circumstances. And so the rule of thumb when deducting policy loan interest is that if you use a policy to do something, that if you had borrowed money from somebody else, the interest to them would be tax deductible. It's likely it's tax deductible to you as well when you use a policy to do it. The uniqueness to it is just simply that the policy continues to earn in what feels like to us, realistically, like a tax-free environment where we're earning growth and dividends without having to pay tax right now, but we can also deduct the interest that we use when we collateralize the account. That's pretty unique and pretty sweet. We love that about it. And one of the best suggestions to do is if you can get to the point where you have policies for personal and policies for business, you don't have to mingle them, life will be really easy and you won't even have to do any sort of accounting really in order to know how much interest is deductible to you at that time. I hope this has been helpful. Once again, if you are liking the show and it's impacting your life and helping you grow in the world of infinite banking, if you would be so kind as to leave us a like or a share or a comment or a review on Apple Podcasts or subscribe on YouTube, it means the world to us. It's the best way to tell the algorithms that this is some good content worthy of being sent out to other people to consume. It's been a pleasure to have you as always. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered. For free transcripts or resources, please visit livingwealth.com/E209.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.